Question 1. An investment advisor representative, IAR, has a client who consistently ignores all of their carefully considered recommendations and instead insists on making highly speculative investments that are inconsistent with the client's stated risk tolerance and investment objectives. Under the Uniform Securities Act, what is the IAR's most appropriate course of action? A. Refuse to execute the unsuitable trades and terminate the advisory relationship. B. Execute the trades as requested but document the client's unsolicited instructions. C. Place the trades as requested after obtaining a signed waiver from the client. D. Report the client to the state administrator for violating their own investment policy. Answer: B. Execute the trades as requested but document the client's unsolicited instructions. An investment advisor has a fiduciary duty to act in the client's best interest and ensure recommendations are suitable. However, if a client insists on placing an unsolicited order that is contrary to suitability, the IAR can generally execute the trade, provided they clearly document that the order was unsolicited and against their advice. It is not permissible to obtain a waiver for suitability, as suitability cannot be waived, nor is it appropriate to report the client to the administrator or automatically terminate the relationship simply for placing an unsolicited order. Remember that while recommendations must be suitable, an advisor is not necessarily prohibited from executing a client's unsolicited instructions, as long as proper documentation is maintained. Question 2. Under the Investment Advisors Act of 1940, which of the following individuals is generally not required to register as an investment advisor, IA? A. A financial planner who provides comprehensive written financial plans for a fee. B. A pension consultant who advises employee benefit plans on investment strategies. C. A person whose advice relates solely to United States government securities. D. An individual who charges a quarterly fee for managing discretionary client portfolios. Answer: C. A person whose advice relates solely to United States government securities. The Investment Advisors Act of 1940 specifically exempts from registration any person whose advice relates solely to United States government securities. This exemption is distinct from exclusions, meaning such individuals do not meet the definition of an investment advisor for federal purposes if their activities are limited to this scope. All other listed activities typically fall under the definition of an investment advisor because they provide investment advice for compensation as a business, and do not qualify for a federal exemption. Keep in mind that federal law has specific exemptions and exclusions that can significantly impact registration requirements. Question 3. An investment advisor, IA, registered with the SEC manages assets for 200 clients. What is the minimum aggregate value of assets under management, AUM, required for an IA to be eligible for federal registration with the SEC? A. $25 million. B. $50 million. C. $100 million. D. $110 million. Answer: C. $100 million. Under the Dodd-Frank Act, the threshold for federal registration with the SEC for investment advisors generally begins when an advisor has $100 million or more in assets under management, AUM. Advisors with AUM between $25 million and $100 million typically register at the state level, unless specific exemptions or rules apply, such as advising registered investment companies. This threshold is a key determinant in whether an investment advisor falls under federal or state jurisdiction for registration purposes. Think of $100 million as the general dividing line for moving from state to federal oversight for most IAs. Question 4. A client, aged 70, is looking to generate income from their portfolio. They are highly risk-averse and concerned about preserving principal. Which of the following investment recommendations would be most suitable for this client? A. A portfolio heavily weighted in high-growth small-cap stocks. B. A diversified portfolio of investment-grade corporate bonds and U.S. Treasury securities. C. A mutual fund specializing in leveraged inverse ETFs. D. An income strategy primarily composed of speculative options contracts. Answer: B. A diversified portfolio of investment-grade corporate bonds and U.S. Treasury securities. For a risk-averse client primarily focused on income generation and principal preservation, investment-grade corporate bonds and U.S. Treasury securities are highly suitable. Investment-grade bonds offer relatively stable income and lower default risk compared to lower-rated bonds, while U.S. Treasury securities are considered the safest investments due to the backing of the U.S. government. High-growth stocks, leveraged ETFs, and speculative options contracts carry significant risk and are generally unsuitable for a client with a high-risk aversion and focus on principal preservation. Always match the investment's risk and reward profile to the client's stated objectives and risk tolerance. Question 5. Which of the following statements regarding the Investment Advisor Brochure Rule, Form ADV Part 2A, is true? A. The brochure must be delivered to clients at least annually, regardless of material changes. B. It is primarily used to disclose an investment advisor's financial condition, including their balance sheet. C. It outlines the investment advisor's services, fees, disciplinary information, and conflicts of interest. D. It must be filed only with the SEC, and is not required to be delivered to clients. Answer: C. It outlines the investment advisor's services, fees, disciplinary information, and conflicts of interest. The Investment Advisor Brochure, Form ADV Part 2A, is a foundational disclosure document that provides current and prospective clients with crucial information about the investment advisor. This includes details on services offered, fee schedules, types of clients, methods of analysis, conflicts of interest, and any significant disciplinary history. While financial condition may be included under specific circumstances, its primary purpose is comprehensive disclosure of the firm's operations and potential conflicts. Always remember the brochure is designed to help clients make informed decisions about engaging an advisor by providing transparency. Question 6. An investment advisor representative, IAR, is performing evaluation of a manufacturing company. The company has stable earnings, pays consistent dividends, and is expected to grow modestly. Which valuation method would likely be most appropriate for this type of company? A. Price-to-earnings, PE, ratio using comparable companies. B. Discounted cash flow, DCF, analysis. C. Liquidation value. D. Sum of the parts valuation. Answer: A. Price-to-earnings, PE, ratio using comparable companies. For a stable company with consistent earnings and expected modest growth, valuing it using a price-to-earnings, PE, ratio relative to comparable companies is often an appropriate and straightforward method. This approach allows for a quick comparison of how the market values similar earnings streams across peer companies. Discounted cash flow, DCF, is often used for companies with more volatile or unpredictable cash flows, while liquidation value is typically reserved for distressed or failing businesses. Sum of the parts is used for conglomerates with distinct business units. When a company has clear peers and stable performance, relative valuation metrics like P/E ratios are often quite effective. Question 7. An investment advisor registered with the SEC is considering offering advice solely on commodities. Under federal securities law, how would this activity impact their registration? A. Their existing SEC registration covers advice on all types of commodities. B. They would need to also register as a commodity trading advisor, CTA, with the NFA and CFTC. C. They would be exempt from any further registration since commodities are not securities. D. They would be required to withdraw their SEC registration and only register as a CTA. Answer: B. They would need to also register as a commodity trading advisor, CTA, with the NFA and CFTC. While an SEC-registered investment advisor provides advice on securities, advice solely on commodities typically falls under the purview of the Commodity Futures Trading Commission, CFTC, and the National Futures Association, NFA. Therefore, To offer advice on commodities as a business, the firm would generally need to register separately as a commodity trading advisor, CTA, with these bodies. Commodities are distinct from securities, requiring separate regulatory oversight. Remember that different types of assets can fall under different regulatory authorities, requiring distinct registrations for specific activities. Question 8. A client has accumulated a significant inheritance and is concerned about the impact of inflation on their purchasing power over the long term. Which of the following asset classes would an investment advisor most likely recommend to mitigate inflation risk? A. Long-term, fixed-rate U.S. Treasury bonds. B. Certificates of deposit, CDs. C. Real estate and commodities. D. High-yield municipal bonds. Answer: C. Real estate and commodities. Real estate and commodities, such as gold or oil, are often considered effective hedges against inflation because their values tend to rise with the general price level. Real estate values and rental income typically appreciate during inflationary periods, while commodity prices often increase as the cost of raw materials rises. Fixed-income investments like long-term treasury bonds, CDs, and municipal bonds are generally vulnerable to inflation because their fixed payments lose purchasing power as inflation rises. To protect against inflation, consider assets that tend to move in tandem with or exceed the rate of inflation. Question 9. An investment advisor has discretionary authority over a client's account. This means the advisor can make decisions regarding all of the following except: A. The amount of securities to buy or sell. B. The type of security to buy or sell. C. The timing of the transaction. D. The specific investment objectives of the client. Answer: D. The specific investment objectives of the client. Discretionary authority grants an investment advisor the power to make decisions about the security, what, the amount, how much, and the action, buy, sell, or timing, when, without seeking prior client approval for each trade. However, an advisor can never determine or alter the client's investment objectives. The client's objectives, risk tolerance, and financial situation are fundamental parameters that the advisor must always adhere to and cannot unilaterally change. Always remember that discretionary authority pertains to trade execution, not to the fundamental financial goals or risk profile of the client. Question 10. Which of the following is considered a red flag indicating potential elder financial abuse? A. A new individual, unfamiliar to the client, suddenly becomes involved in their financial affairs. B. The client frequently discusses their investment portfolio with family members. C. The client regularly reviews their account statements and asks questions. D. The client expresses a desire to change their investment objectives to be more aggressive. Answer: A. A new individual, unfamiliar to the client, suddenly becomes involved in their financial affairs. A significant red flag for potential elder financial abuse is when a new individual, previously unknown to the client, suddenly gains access to or exerts undue influence over the client's financial decisions or accounts. This abrupt involvement could indicate coercion, fraud, or exploitation. While other options represent normal client behavior or legitimate changes, the sudden introduction of an unknown third party into financial matters warrants immediate suspicion and investigation. Always be vigilant for sudden, unexplained changes in a client's financial behavior or relationships, especially when they involve a vulnerable adult. Question 11. An investment advisor representative, IAR, is recommending a bond mutual fund to a client. The client is concerned about interest rate risk. Which type of bond fund would be least affected by changes in interest rates? A. A long-duration corporate bond fund. B. A short-duration U.S. Treasury bond fund. C. A high-yield municipal bond fund. D. An international emerging market bond fund. Answer: B. A short-duration U.S. Treasury bond fund. Interest rate risk is the risk that changes in interest rates will negatively affect a bond's price. Generally, longer duration bonds are more sensitive to these changes. Therefore, a short-duration U.S. Treasury bond fund would be least affected by changes in interest rates because its portfolio consists of bonds with shorter maturities, making their prices less volatile. Additionally, U.S. Treasury bonds carry minimal credit risk. Always remember that bonds with shorter durations and higher credit quality are generally less exposed to interest rate fluctuations. Question 12. Under the Uniform Securities Act, an investment advisor, IA, who has custody of client funds or securities must generally a. Maintain a net worth of at least $10,000. b. Provide clients with quarterly account statements prepared by a qualified custodian. c. Be subject to an annual surprise examination by an independent public accountant. d. Post a bond for at least $35,000 in the state where they are registered. Answer: C. Be subject to an annual surprise examination by an independent public accountant. Under the Uniform Securities Act, and similar federal rules, an investment advisor that has custody of client funds or securities is generally required to undergo an annual surprise examination by an independent public accountant. This examination verifies the existence of client assets and ensures proper safeguarding. While maintaining a net worth or bonding might be required under specific state rules, and qualified custodians provide statements, the annual surprise audit is a direct and mandatory measure for IAs with custody. Custody triggers heightened regulatory scrutiny, and the surprise audit is a critical component of that oversight. Question 13. Which of the following is not a characteristic of a real estate investment trust, REIT? A. They typically own income-producing real estate. B. They trade on exchanges like stocks. C. They are required to distribute at least 90% of their taxable income to shareholders annually. D. They pass through losses to investors, allowing for tax write-offs. Answer: D. They pass through losses to investors, allowing for tax write-offs. Real estate investment trusts, REITs, are structured to avoid corporate taxation by distributing a significant portion, at least 90%, of their taxable income to shareholders, effectively passing through income, not losses. Unlike limited partnerships, which can pass through losses to investors, REITs do not pass through losses for tax write-off purposes, they focus on income generation. REITs do, however, typically own income-producing real estate, trade on exchanges, and offer liquidity, making them a common way for investors to gain exposure to real estate without direct ownership. Question 14. An investment advisor recommends a complex structured product to a client. What is the most important factor for the advisor to consider when determining the suitability of this product for the client? A. The advisor's compensation structure for selling the product. B. The client's understanding of the product's risks, features, and liquidity. C. The recent performance history of similar structured products. D. The product's rating by a nationally recognized statistical rating organization, NASAA. Answer: B. The client's understanding of the product's risks, features, and liquidity. When recommending complex products like structured products, the client's understanding of its intricate risks, features, and liquidity is paramount for suitability. Advisors have an ethical and regulatory obligation to ensure clients comprehend what they are investing in, especially for non-traditional or highly leveraged instruments. While compensation, past performance, and ratings are relevant, a client's informed consent based on clear understanding is the cornerstone of suitability for complex investments. Always prioritize the client's ability to grasp the intricacies of the investment over other factors. Question 15. Under NASAA's Model Rule on Unethical Business Practices of Investment Advisors, which of the following actions is considered unethical? A. Charging a reasonable hourly fee for financial planning services. B. Failing to disclose to a client that the advisor will receive a commission from the sale of a recommended security. C. Delivering the investment advisor brochure to a prospective client 2 days before entering into an advisory contract. D. Providing general economic commentary to clients on a monthly basis. Answer: B. Failing to disclose to a client that the advisor will receive a commission from the sale of a recommended security. Failing to disclose a material conflict of interest, such as an advisor receiving a commission from the sale of a recommended security, is a clear violation of an investment advisor's fiduciary duty and an unethical business practice. This non-disclosure prevents the client from making an informed decision, as the advisor's incentive may not align purely with the client's best interest. Charging reasonable fees, timely brochure delivery, and providing general market commentary are generally acceptable practices. Always remember that transparency about conflicts of interest is a core ethical principle for investment advisors. Question 16. A client approaches an investment advisor representative, IAR, seeking to invest funds for their newborn child's college education, which is 18 years away. The client expresses a high tolerance for risk. Which of the following asset allocations would generally be most appropriate? A. 90% money market funds, 10% U.S. Treasury bonds. B. 60% equities, 30% fixed income, 10% cash. C. 100% investment-grade corporate bonds. D. 20% equities, 80% fixed income. Answer: B. 60% equities, 30% fixed income, 10% cash. For a long-term goal like college education 18 years away, combined with a high-risk tolerance, a significant allocation to equities, stocks, is generally appropriate. Equities offer the greatest potential for long-term growth and capital appreciation, which is crucial for combating inflation over an extended period. While fixed income and cash provide stability, a heavily conservative portfolio would likely fall short of meeting the long-term growth needs. Remember, a long time horizon and higher risk tolerance typically support a greater allocation to growth-oriented assets like stocks. Question 17. An investment advisor registered with the SEC is subject to routine examinations by the SEC. What is the primary purpose of these examinations? A. To assess the advisor's financial solvency and ability to pay potential client claims. B. To verify the advisor's adherence to federal securities laws, rules, and fiduciary obligations. C. To provide compliance recommendations and assist the advisor with operational improvements. D. To determine if the advisor is engaged in insider trading activities. Answer: B. To verify the advisor's adherence to federal securities laws, rules, and fiduciary obligations. The primary purpose of SEC examinations of investment advisors is to ensure compliance with federal securities laws, such as the Investment Advisors Act of 1940, and to verify that the advisor is upholding their fiduciary duty to clients. These exams are regulatory oversight mechanisms designed to protect investors by identifying and correcting potential violations or deficiencies. While they might uncover financial issues or provide implicit guidance, their core function is enforcement of regulatory compliance. Think of SEC exams as a regulatory health check, ensuring the advisor is following all applicable laws and acting in clients' best interests. Question 18. Which of the following is an example of market manipulation? A. An investment advisor purchasing shares of a company after publishing a positive research report about it. B. A large institutional investor executing a block trade through an exchange. C. An individual creating false rumors about a company to drive down its stock price before buying shares. D. An issuer buying back its own shares through a pre-announced program. Answer: C. An individual creating false rumors about a company to drive down its stock price before buying shares. Creating false rumors about a company to manipulate its stock price, commonly known as spreading false information or bear rating, if done to drive prices down, is a clear example of market manipulation. This activity artificially influences supply and demand based on misleading information, violating fair and orderly markets. Purchasing shares after publishing a research report, if disclosed, block trades, and issuer buybacks are generally legitimate activities, provided they adhere to regulatory guidelines. Always recognize that actions designed to artificially influence prices or create a false appearance of activity are prohibited forms of market manipulation. Question 19. An investment advisor representative, IAR, is evaluating two bonds. Bond A has a coupon rate of 5% and a yield to maturity, YTM, of 4.5%, while Bond B has a coupon rate of 4% and a YTM of 4.5%. Both bonds have similar credit ratings and maturities. Which statement is true? A. Bond A is trading at a discount, and Bond B is trading at a premium. B. Both bonds are trading at a premium. C. Both bonds are trading at a discount. D. Bond A is trading at a premium, and Bond B is trading at a discount. Answer: D. Bond A is trading at a premium, and Bond B is trading at a discount. When a bond's coupon rate is higher than its yield to maturity, YTM, it indicates the bond is trading at a premium. Conversely, when the coupon rate is lower than the YTM, the bond is trading at a discount. For Bond A, 5% coupon, 4.5% YTM, the coupon is higher than the YTM, so it's trading at a premium. For Bond B, 4% coupon, 4.5% YTM, the coupon is lower than the YTM, so it's trading at a discount. A bond's price moves inversely to its YTM relative to its coupon rate. Question 20. An investment advisor registered with the SEC is required to file Form ADV annually. What is the typical deadline for this annual updating amendment? A. Within 90 days after the end of the advisor's fiscal year. B. Within 30 days of any material change. C. By December 31st of each year. D. Within 45 days after the advisor's initial registration date. Answer: A. Within 90 days after the end of the advisor's fiscal year. SEC-registered investment advisors are required to file their annual updating amendment to Form ADV within 90 days after the end of their fiscal year. This annual filing ensures that the information provided to the SEC and to clients through the brochure remains current and accurate. While material changes require prompt amendments, typically within 30 days, the annual update has a distinct, longer deadline. Remember the 90-day rule for the annual Form ADV update. It's a critical compliance deadline. Question 21. Which of the following best describes the soft dollar safe harbor under Section 28(e) of the Securities Exchange Act of 1934? A. It allows investment advisors to receive direct cash payments from broker-dealers for client referrals. B. It permits investment advisors to pay higher brokerage commissions for research and brokerage services that benefit clients. C. It enables investment advisors to use client commissions to pay for personal expenses if disclosed. D. It exempts investment advisors from disclosing any conflicts of interest related to commission-based compensation. Answer: B. It permits investment advisors to pay higher brokerage commissions for research and brokerage services that benefit clients. The soft dollar safe harbor under Section 28(e) allows an investment advisor to pay a broker-dealer slightly higher commissions than might otherwise be available, provided the extra cost is used to obtain bona fide research and brokerage services that ultimately benefit the client. This provision permits a limited form of bundled payment for execution and research without it being considered a breach of fiduciary duty or a prohibited kickback. It specifically requires the services to be directly related to the advisory services provided to clients. Always remember that soft dollar arrangements must be for the benefit of the client and involve research or brokerage services, not personal perks. Question 22. A client wants to ensure their investment portfolio maintains a consistent asset allocation automatically without frequent manual rebalancing. Which portfolio management strategy would be most suitable? A. Tactical asset allocation. B. Strategic asset allocation. C. Constant dollar plan. D. Rebalancing with a predetermined corridor. Answer: D. Rebalancing with a predetermined corridor. To maintain a consistent asset allocation automatically without frequent manual rebalancing, rebalancing with a predetermined corridor is the most suitable strategy. This involves setting specific percentage ranges, corridors, for each asset class, and only rebalancing when an asset class's weighting moves outside its defined range. This automated approach ensures the portfolio periodically returns to its target allocation without requiring constant oversight. Tactical asset allocation involves actively shifting allocations based on market outlook, while strategic asset allocation sets a long-term target but doesn't prescribe the rebalancing method. Constant dollar plans are about fixed dollar amounts, not allocation. Question 23. An investment advisor representative, IAR, is discussing the efficient market hypothesis, EMH, with a client. If the market is strong form efficient, which of the following statements would be true? A. Only public information is reflected in stock prices, allowing insiders to profit from private information. B. All public and private information is fully reflected in stock prices, making consistent outperformance impossible for anyone. C. Past price movements can be used to predict future stock prices, but fundamental analysis is ineffective. D. Fundamental analysis can identify mispriced securities, but technical analysis is ineffective. Answer: B. All public and private information is fully reflected in stock prices, making consistent outperformance impossible for anyone. Under the strong form efficient market hypothesis, EMH, all information, both public and private, insider information, is immediately and fully reflected in stock prices. This implies that no investor, not even those with access to non-public information, can consistently achieve abnormal returns. In essence, the market is so efficient that opportunities to profit from any information are immediately eliminated. Understanding the EMH helps in setting realistic expectations about investment performance and the value of active management. Question 24. A client, a single mother with 2 young children, has saved diligently and wants to establish a retirement plan that allows for tax-deductible contributions and tax-deferred growth, but she is self-employed. Which retirement plan would be most appropriate for her? A. A 401k plan. B. A Roth IRA. C. A simplified employee pension, SEP, IRA. D. A traditional IRA. Answer: C. A simplified employee pension, SEP, IRA. For a self-employed individual seeking tax-deductible contributions and tax-deferred growth, a simplified employee pension, SEP, IRA is often the most appropriate choice. SEP IRAs are retirement plans designed for self-employed individuals and small business owners, allowing for much higher contribution limits than traditional or Roth IRAs, and contributions are tax-deductible. While a traditional IRA offers tax-deductible contributions, its limits are much lower. A 401k is typically for employees of larger companies, and a Roth IRA features after-tax contributions. When considering retirement plans for self-employed clients, always consider SEP IRAs or solo 401ks for their generous contribution limits. Question 25. Which of the following actions by an investment advisor is most likely to constitute custody of client funds or securities under the Uniform Securities Act? A. Accepting a third-party check from a client made payable to a mutual fund. B. Receiving a client's securities certificate and holding it for safekeeping. C. Having discretionary authority over a client's account at a qualified custodian. D. Being authorized to deduct advisory fees directly from a client's account held at a broker-dealer. Answer: B. Receiving a client's securities certificate and holding it for safekeeping. Receiving a client's physical security certificate and holding it for safekeeping unequivocally constitutes custody under the Uniform Securities Act, as it grants the investment advisor direct possession and control over client assets. While deducting advisory fees or having discretionary authority might trigger certain custody rules or notifications, simply having control over a separate qualified custodian account or receiving a third-party check for a specific purpose typically does not. Direct possession of client assets, even for safekeeping, significantly heightens an advisor's responsibilities and regulatory obligations.